as it currently stands, and I think we need to be waiting for the results, there's still going to be a huge need to understand the quality. So just the fact that credit has been approved in Article 6.4 doesn't necessarily mean that reversal risk is low. It doesn't mean that delivery risk is low. And it also ultimately doesn't mean that the policy risk is super low. So I just also want to flag that quality in itself will still remain a huge question that buyers will need to figure out under Article 6.4.
Carbonsations, today's carbon industry leaders.
Welcome to the Carbonsations podcast, where we speak to some of the leading figures in the emerging carbon industry. We're joined today by Magnus Drewelies, the CEO and founder of CEEZER, a Berlin-based platform that puts enterprises in touch with the voluntary carbon market. Magnus, it's a pleasure to be speaking with you, and thank you so much for joining us. Now, I remember interviewing you a little over a year ago for the Carbon Herald, and back then you shared that your journey into the carbon space was a rather conscious one, so I'd love it if you could please share with our audience your background and work prior to founding CEEZER.
Absolutely. And thanks for having me, Violet. I'm super excited to be here. So as you rightfully said, I had a quite conscious journey into the carbon markets. I originally studied business and technology with a focus on chemistry, so came a bit more from the scientific side of things, and was always looking for, let's say, opportunities where both, a chemical or a scientific approach and a business and financial approach would make sense. And the carbon markets were one of the few areas where both of this would come into play. And this was before I ever started working. That was really early, though. The carbon markets were at a very different time and a very different, let's say, maturity level at that point in time. So I decided to first understand the buyer and corporate side. I joined VCG, worked there for 5.5 years, mostly with industrial goods clients, but always tried to include, topics like climate change into the long-term strategy. So especially for, you can imagine, automotive companies, for metals and mining, for aerospace, climate and CO2 were even like 10 years ago quite a significant question of, what's our long-term license to operate? What can we do? And yeah, that's where I found, I think, a lot of the inspiration for doing CEEZER. In the end, I did see in practice that it was really hard to get to zero for most industries. I think today we know it, almost all industries will have trouble to really get to zero. And so I got more and more interested into, well, what do we do when we are at the end of internal decarbonization? And I felt that there's a lot to do still to get CDR and carbon credits on the right track.
Excellent. So given your involvement in the carbon market, I was wondering about your observations of the VCM and how it's changed over the past year.
So I think the past year was interesting in multiple aspects. I think first what we saw is that the retirement volumes stayed relatively stable. So we didn't see a huge increase in further retirements. I think we're probably like 0.5% up compared to the year before, which means that despite the quality concerns and the quality discussions that there were in the past, buyers stay stern, or at least, the commitment isn't going down. What we did, however, see is that the overall market did increase by value for around, we were looking at roughly 12 to 20% an estimate. I mean, that is mainly driven that the average price per ton is getting up. And if we dig one level deeper, what we can see is that the price increase on average mostly comes from removal credits. And this is not only hardcore CDR, it's also nature-based removals and, let's say, more accessible removal technologies. On average, we're looking at, in our observations, a roughly 15% increase over the last 12 months in removal, while the avoidance prices on average actually went down by around 6%. And how can that lead to a significant increase in the market size? Well, we do also see that buyers more and more, and really across the board, across all industries, are heavily moving towards removal-only portfolios. The removal share is increasing if they're not already at 100%. And I think that's a really exciting development to look at, right? Especially if we look towards net zero commitments and net zero targets. This is exactly the kind of development that we would have foreseen. What we still see is that obviously the more accessible and, let's say, lower price removal is definitely having the largest traction. So that's nature-based removals like ecosystem restoration. And this remains by and large the largest removal category that we see, both by volume and by value. But we do also see that, technical CDR and permanent removal technologies have been increasing quite a lot. I think we're looking at roughly 2 to 3x of growth in the last year. Again, I think a good sign that this is started to gain traction, because these are technologies that we will also need to complement all decarbonization efforts.
Okay. And with that in mind, what would you say the current main risks are in the market?
I think, the topic of quality risk in all its shapes and forms definitely is still the biggest concern I think that buyers have. And I think the way that we look at it, and I also personally look at it, is you're not going to have a zero risk credit. It's not something that will exist anytime soon or maybe even ever. You will have to balance different risk categories and different risk dimensions. So if you look at the overall market, there's obviously a myriad of technologies and a myriad of methodologies. And it's really about combining the best possible things that fit into your budget, but also that complement each other within your portfolio. So if you, for example, have a large part that is nature-based, you're obviously exposed to risks like, let's say, wildfires, but you also have maybe, it's more challenging to monitor correctly and to have a very, very good on-the-ground view of what's actually happening. There's a risk of over-crediting. So you can complement those credits maybe with credit that come from a different technology stack where those risks aren't as prevalent. And that allows you to kind of balance a bit out and make sure that you don't put all the eggs into one basket. I think that's probably the most practical thing that I would see for buyers. I think if you look at the overall market, there's definitely still, I think the risk right now that is probably in everyone's mind is definitely also policy backing and backing in the leading, in leading nations. So will climate policy remain strong and keep supporting also, voluntary schemes? I think everyone's looking currently at COP. I think we already got some soft news today on Article 6.4, which is great. But really to understand what's the support that will give companies and buyers security that their investments are actually, kind of worth it and able to contribute to global and also individual goals. And I think this is still something that's kind of part of the discussion, I think, on top of everyone's mind. And ultimately, like in any market, I think we also need to observe a bit what the macro development does. So are we looking at, if macro development remains difficult, if there's obviously a lot of, challenges just economically, the risk is definitely that climate investments will go down, both by the public sector and the private sector, by the way. So it's really a very decisive time, I think, over the next year to see how we as a almost like word community can come together and ensure that climate solutions find the right financing and the right support.
That's definitely a lot of risks you mentioned, but like moving away from the bigger picture, how does CEEZER specifically mitigate those risks?
Absolutely. So we've always been really focused on data and trying to make everything as tangible as possible. So at CEEZER, we look at very specific risk profiles. So ultimately, we give every buyer data on risk behind every credit. We look at over 10 categories of risk, and that includes things like, the host country risk. What's the risk of reversal? What's the risk of overcrediting? And we really put data points behind it. We leverage over 3.5 million data points on quality, over 10 million data points on prices and volumes. So we can really make it kind of very rational thing to understand what's the risk that this project will not be available at that price in a year? What's the risk that, I'm committing to a certain purchase, but actually this won't be available for me when I actually should receive it? What's the risk that I won't get my delivery? What's the risk that things will do? So by using data to kind of validate and in a way quantify it, we really help buyers understand how to best mitigate and how to best, look at these things. It also helps to really, I want to say, know where to look deeper, because I think most large buyers that we work with do their own due diligence, which is great. But what it helps is to make that easy, more accessible and quicker. And I think by looking at, an overall risk profile, you really quickly understand, okay, these are like the 3-4 points for the specific project that I want to dive deeper into, where I want to redo my research and understand if it's working out. And ultimately, I think that really moves away from, kind of, I don't want to say blindly investing, but really to really understand and document a bit like how decisions can be made and how you can, have the best possible opinion at that point in time. The other thing that we do is obviously work with portfolio design. So if we think about how we set up a portfolio over multiple years or towards net zero, we can use a lot of different tools from our toolkit to make sure that delivery will be there, that we have replacements in place should something go wrong, that, we can judge, for example, also quality indicatively before the first issuance. So, and ultimately also kind of working with insurance to make sure that the last risks are also covered in the worst case. So I think many buyers don't really know yet that there is such an advanced tool stack already in place that you can use today to make really impactful climate decisions.
Magnus, another question I have, because with risks, kind of one of the things that automatically comes to mind is insurance. So what's your take on carbon insurance? Is it something that you use already? Is it something you might be looking into? How do you view this at all?
Yeah, I mean, first of all, I think it's absolutely needed, right? Carbon remains a super risky asset category. You have a lot of just on-the-ground project risks that are really, really hard to manage, I think, for buyers, especially if you're investing in multiple projects at the same time, which you should be doing for other consideration. So you kind of have to deal with this, kind of double bind of you need to invest in multiple projects at the same time. You can't probably understand all the risks and manage all the risks proactively in every kind of project. So insurance really does play that role to make sure that you can still feel safe about it, and you can make sure that the worst kind of effects in a worst case would be averted and you don't suffer from them. We do work with multiple insurance providers on a case-by-case basis. I think the one thing that we really need to mature is like what exactly is insurable. So there's a lot of different models out there right now. So some offer replacement credits, right? Where that's maybe great because if you get money but the credits aren't available, obviously the money won't help you to make your target. At the same time, you might want to have more control over what you get replacement for, right? So it's always like a bit the question of what can they replace with. Other insurances only, for example, insure the price differential. So if I don't get a credit delivered that I bought 2 years ago and it's now more expensive, I will get the price difference back. That again is also interesting from a financial perspective, but maybe it doesn't help you find the right credit when you need it then at that point in time. So I think we're still early. That's probably my main message. And I think from our observations, we don't really have like the one-stop solution or like the one fully blown insurance setup that I think can cover all the types. But I think that's also fine. We're working on it. I think the market is really moving towards it. We have made so much progress, and by we, I mean the market, and more specifically all the insurance players and all the great teams working on carbon insurance out there can become, for many parts of it, can become a powerful tool. But there's a lot of work to do. I think we need to cover more project types. We need to cover more types of risks. And I think we also need to work on kind of more standardization around what the offer actually looks like.
Excellent. Thank you so much. Another thing I wanted to ask you about with regards to how CEEZER operates is the partnership with Carbonfuture that you recently struck. I was wondering if you could tell us more about it, like how it came about, and more importantly, how it's improving access to high quality credits.
Absolutely. So Carbonfuture and CEEZER, we have a long history of knowing each other. So we share a lot of, contacts. We I think also are probably two of the players in Europe that really have a lot of great progress in terms of CDR. So it was kind of natural for us to think about how can we work together to like amplify what we're doing and to make sure that buyers get the best access. So Carbonfuture focuses on, certain CDR types. They do live MRB. So they focus much more on also getting live data on, specific projects, while CEEZER traditionally always like offered a broader range of credits. And we offer a lot of more tooling for buyers to manage those credits post-purchase, right? So to really take care of your inventory, how to report on those, can you like give it to suppliers, how can you make buyers join, et cetera, et cetera. So we kind of have a very complementary, let's say, footprint, a complementary view of what we do in our product. And so ultimately, our partnership works in a way that we are sharing some of our inventory. So buyers on CEEZER can access Carbonfuture inventory. They can have access to the data that Carbonfuture offers on top. And at the same time, buyers of Carbonfuture can also use some of the tooling that CEEZER is using. I think it's been going really well. We really, I think we're both obviously based in Europe. I think that's kind of a natural touch point, but I think we also often work with similar organizations. So that has been super well. And I think that's really special about the carbon market, I think, at this point in time, is that there's such a spirit of collaboration that good solutions will always try to, work together to make sure that most buyers can have access to the best in the market.
Absolutely. And kind of in that line of thought, I also wanted to talk more about the CEEZER Carbon Coalition. I know you guys celebrated the graduation of the second cohort at the end of the summer, if I'm not mistaken, but I'd certainly love it if you could tell us more about this endeavor, like how it came about, whose idea it was, and what impact you see it having so far.
Absolutely. So maybe for those that don't know, the Carbon Coalition is a program that we run currently biannually, where we help early stage CDR suppliers of all possible types to kind of fast track their go-to-market. So it came out of basically two perspectives. The one is that we got a lot of requests from really promising CDR suppliers that were just too early for us to onboard on our regular product. We have certain requirements in terms of project maturity, available supply, how far along you are in the carbon journey, like in the project journey, because we need to guarantee, just certain quality and kind of reliability for buyers. At the same time, we always wonder, and it's core to our company, is always like, how can we help this market grow? How can we help this market scale? And one thing that we heard over and over is that the insights that we had talking to those early developers on, listen, like this is what buyers are looking at. This is the kind of certification scheme that we would see like most promising for the project type. This is how we normally see pricing in the space. This is how we would normally, communicate value beyond just the carbon impact. We're super valuable to those early stage project developers. So we wanted to really kind of invest in a way into these companies in the way that we can, which is by sharing all of that information. And yeah, we're incredibly excited that we already have 14 different graduates from 2 cohorts that are now listed live on CEEZER, which means you, as a participant, you get a featured listing on the platform. You'll be available to our entire buyer base. We also mark Carbon Coalition participants with like an additional kind of like stamp on platforms so people know they've been through the program, they've been vetted by us, we've been working with them early on. And you can, let's say, list supply before, a normal project developer would be able to do so on CEEZER. So it's really also in order to like give early access to buyers, but really also giving early offtakes to the supply side. This has been going incredibly well. We're always so grateful for all the applications that we're getting, and I'm happy to announce that we're starting the next application cycle this December. So please keep your eyes open and look out for it. And if you're in the space, if you're an early stage CDR developer of any project type, nature-based or technical, do feel free to apply. I think it's a really, really fun program, and it's not super heavy. It's kind of good to do on the side as well. And I think the next cohort will then launch or start in February next year to go through the process of understanding what supply is, where MRV stands right now, what we see on the buyer side. And like in the last cohort, we will also do a live buyer session. So we get actually corporate buyers in the room, and we offer like an exclusive hour to just chat and share ideas and have real buyers explain what they're looking for and how that works.
That's certainly super exciting. I think it would also be helpful if maybe you could share some of your criteria as to what you're looking for in applicants.
Absolutely. So we're looking for CDR, so carbon removal suppliers or project developers at a fairly early stage. Ideally, you have a technology that is pre-validated. Ideally, you are planning on certifying under a recognized standard. And obviously, your project and technology needs to be, in its traditional senses, additional both from policy, a financial perspective, but also from environmental perspective. As I said, it can be both nature-based solutions, it can be technical solutions, it can be all hybrid solutions. Yeah, and I think everyone who's planning on entering the VCM and on selling CDR in the VCM is very much welcome to apply.
Are there any geographical restrictions, or you work with, suppliers everywhere?
We've always been working globally. So even our existing, let's say more mature supplier base is literally around the globe. So as long as the technology is great, we want to support.
Brilliant. So kind of furthering that, so you're doing a lot of work to kind of help the carbon market grow in general. And where do you really see it headed in the future, particularly with so much talk of a convergence between the VCM and compliance markets, as well as you mentioned that COP29 now holds promise of an agreement of Article 6. How do you see all this impacting the market? And not optimistically, realistically, where do you see it headed in the next years, maybe leading up to 2030?
Right. So I think whenever I'm asked the question where it's heading, right, I think there's one fundamental truth that I think that will give a lot of the answer in the long term, which is we will need negative emissions to make almost all target scenarios. So one way or another, carbon removal will be required to make our joint Paris pathways, but every more ambitious pathway anyways. So I think it needs to be there, and we need to make it really, really impactful. I think I do see the theme of compliance and voluntary emergence on multiple levels. I think I've been personally talking about it for a while, and I think it's also quite an exciting development. So obviously, if we look at COP29 now, we're expecting and looking at a further or final kind of operationalization of Article 6.4, which would allow for trade of kind of NDC adjusted credits. This will be, as far as it currently stands, almost on avoidance and removal. So it's not even, only focusing on the removal part of the market. But essentially what it will mean is that projects can get letters of authorization to be traded, and they can basically be accounted for under the Paris scheme. And I think this is, if anything, a good signal and for buyers that this has not been double counted, that this is an impact that has been duly registered in the national registries, which I think is often a concern that buyers have when they enter the market. What I also want to say is that as it currently stands, and I think we need to be waiting for the results, there's still going to be a huge need to understand the quality. So just the fact that credit has been approved in Article 6.4 doesn't necessarily mean that reversal risk is low. It doesn't mean that delivery risk is low. And it also ultimately doesn't mean that the policy risk is super low. So I just also want to flag that quality in itself will still remain a huge question that buyers will need to figure out under Article 6.4. That said, obviously, this is an entryway where projects that have been operating purely in the voluntary market suddenly kind of come sideways part of the global compliance scheme, if you want to call the Paris Agreement that. But I think more interestingly, and this is, I think, something that I've been observing a bit more closely, is that the currently biggest running compliance scheme, the EU ETS, is already planning and has already been decided to include at some point carbon removals into its compliance scheme. And I think this is extremely exciting development if you look at the fact that we finally have a mechanism in place where companies or buyers can choose if they want to kind of buy allowances from other players or if they actually want to buy carbon removal. And I recently published a white paper together with EY, so the large Big Four, where we actually looked at price predictions of carbon removal, how it's currently expected to price down, but we also looked at the price predictions on the EU ETS prices. And this model, we basically found that in 2032, there might already be an inflection point that the EU allowances will be more expensive to buy than certified durable carbon removal will be at that point in time. And I think then it is obviously, I think, an interesting and good mechanism to think through. Can compliance schemes and compliance market leverage things like permanent and durable carbon removal to allow companies to have the most, let's say, efficient way to get to net zero? And this will surely increase spending in the market because it's both a cost benefit, but it's also ultimately a larger planetary benefit in a way. So I think the convergence of compliance and voluntary in our mind, I think, is always a huge opportunity. I think it's probably where the world needs to move at some point. And I think the risk in all of this is obviously the exact mechanism, how it will work. But there, I think currently we do look at a few kind of really good proposals that are out there, both on EU level, but also in Paris level. I think both speak for a growth in the market. I think what will continue is the shift to removal more broadly, both in the VCM, but also in compliance schemes, or at least the more mature compliance schemes. And I also think that removal prices will keep rising. So what we see is that while the shift to removal is pretty prevalent in the portfolios of buyers, so a lot of portfolios include way more removal than it did like 2-3 years ago, we haven't really seen the pipelines for carbon removal grow at the same pace, which means that at some point, supply might be a bit scarcer for carbon removal, which is again driving up prices quite a bit. So again, I think if you as a company have a net zero target, it's probably a good time right now to think through how will I achieve this and what are the options for me to kind of secure supply relatively early, or at least secure prices and supply of those projects that I think would fit my requirements. And at the same time, we still are looking at an oversupplied market. So both in removal and avoidance, there is much more supply than we actually see consistent demand. So we're not yet at the point where we're scrambling for, globally scrambling for supply. But I think the right supply and high quality supply is already kind of harder and harder to find as big buyers are getting in and purchasing this.
Two things. First off, the white paper you mentioned, is it readily available? Can anyone just access it, read it?
Absolutely. So the white paper is called Generating Value with Green Carbon. It was published and launched by EY and CEEZER at New York Climate Week, and you can download it both on CEEZER's website, but also on EY's website.
Okay, for sure. Then I'll include a link for it in the description for those listening. And another thing I wanted to get your take on was since you mentioned policy and specifically in the EU CRCF, how do you see that shaping up and shaping the market?
I mean, so I think, this EU CRCF in my mind, and I'm happy to be challenged on this, but I think it's almost like the pre-step to a potential inclusion of carbon removal into the EU ETS. So the CRCF, so the Carbon Removal Certification Framework, obviously is the first step of the EU to kind of define this is what we accept is carbon removal, right? And I think, although it hasn't really been launched for that purpose, but I think that most probably the prerequisite for any kind of future inclusion. So first of all, great, this is happening. I think we just saw the first methodologies being reviewed. I think the first list is now out. And so I think the second one is planned for end of next year to look at the next range of project methodologies that will be applicable under any kind of EU scheme. So I think this is a very necessary and timely first step to understand what will be, considered carbon removal, to then also think about how to include this in the EU ETS. I think right now it's not yet, at least I couldn't observe like a big impact of this on its own, but I think over the next year we will certainly see that project developers that are based in Europe at least, will probably start to align more and more to the EU CRCF, which is a smart decision, right? To kind of be in the scope of potential compliance integration relatively early.
Excellent. Magnus, thank you so much for the breakdown of where policy is right now and where we might see things headed in the future. But before we wrap up this episode, I would like to ask you one more thing, and that is what CEEZER has in the pipeline. Are there any new developments, new product launches, or any kind of other future announcements on the horizon that you could tell us about right now?
Absolutely. So from CEEZER's perspective, right, there's like three things we always really want to do really well. The one is like ensuring everyone is able to easily and quickly invest in the best possible negative emission that they can. So we've always been working with portfolios. We've always been trying to make durable removal very easily accessible. And the second thing that we've always been doing is working more with to make it really easy to co-invest and to collaborate. And I think one amazing thing that we're currently launching is our supply product. So essentially, we now allow companies that are already managing their own carbon removal portfolio or carbon portfolio on CEEZER to invite suppliers to co-invest. And this, I think, can be super powerful, right? It makes it easier for suppliers to really hit their requirements in terms of climate. At the same time, it allows buyers of certain goods to understand in detail what are the negative emissions that come with my products, what negative emissions have been used by my supplier base, and to give really live visibility on this. And what it ultimately does, it really allows for companies to kind of collect investment and capital outside of their own scope to look at the most impactful thing that they can do. So that's one thing that's happening. The other thing, we already launched it also just shortly before Climate Week New York this year, is our white label product. We're now actually offering CEEZER for other parties to use our infrastructure to invest into, highest impact climate action. So this is another great thing. We're working with a bunch of consultancies, traders, to really kind of share what we've built over the past years and make it the most impactful possible, which can also be by other parties.
Excellent. Magnus, as before, it was a great pleasure to speak to you, and I'm excited for all the great things CEEZER has going on right now. Thank you so much for coming on the show and sharing your progress with us. It was lovely to have you.
Thank you, Violet, and pleasure to be here.
If you enjoyed this episode of the Carbonsations podcast and would like to hear more conversations like this, please be sure to subscribe. We really appreciate the support.